Hi there, this is Rob Hanna of InvestiQuant. I'm the co-founder and VP of Research here, and I am very excited to be here at Traders World talking about our newest research for trading opening gaps. This is all new stuff. Even if you followed InvestiQuant for a long time, you have not seen this before, so I'm excited to be able to present it. Before I get going, just need to give you a minute or so to look at the risk disclosure statement here. Some of the information I'll be sharing is derived from back-tested data. Backtesting has inherent limitations. It is one of my favorite ways to learn about the market, though, and I found it to be valuable over the years. But as I said, trading is risky, and the market does not always act as it has in the past. So with that said, let's get going. For those of you that don't know me, I have been a full-time trader since 2001. Run money professionally over that time. In 2003, I began publishing some market commentary and research that I did. And in 2008, I founded the Quantifiable Edges website. In 2012, I opened another website called Overnight Edges. And in 2014, Overnight Edges merged with the old Master the Gap site run by Scott Andrews, who is the Gap guy, and became InvestiQuant. So I'm a co-founder here at InvestiQuant, and as I already mentioned, the VP of Research. So a lot of the new research you're seeing is stuff I've done in conjunction with Scott Andrews as well, who does a lot of the Gap work here at InvestiQuant. I'll show this slide at the end as well, but it will be an opportunity for you to go in and download Scott's book, Understanding Gaps. He wrote it several years ago. It's got a lot of good material in it. It goes beyond what we're going to show today as far as the fading the gap stuff. So let's get into what I'm going to show today. Here's a little agenda so you have an idea of what I'm going to be talking about. I'll introduce the concept of gap trading for those that aren't familiar with it, and then we'll help you understand the basics of fading the gap, which has been Scott's favorite setup for years. And then I'll share some helpful gap trading statistics for you that'll give you an idea of where the edges lie. I'll explain the logic for trade selection and money management with some of these trades. And then I'm going to wow you with some of IQ's newest research for what we call following the gap. And we'll get into what the definitions of fading and following are in a minute. I'll show you some tools that we have available in InvestiQuant to help you with your fading and following the gap trade. And I'll give you an opportunity to learn more. So let's just start off with the basics of gap trading. The very basic question is, what is a gap? Well, a gap's the difference between a security's opening price and yesterday's closing price. You can see the difference on a price chart as a vertical space or a gap. Let me show you a couple examples. This is an example of a gap up. All right, so this is a 5-minute chart, and this was the close yesterday, and this is the open this morning. As you can see, the price opened well above where it had closed yesterday, so we refer to this as a gap up. The next example is of a gap down. So here we have the market moving higher in the last half hour or so of the day, and then it starts off with a price that opens well below the previous day's closing price. This is a gap down. There's a number of different ways to trade gaps, and we're going to get into them. Let me give you a few key definitions. First, though, fading is basically to trade in the opposite direction. So if I say a gap fade strategy or a gap fade trade, that basically means if the market gaps down, you're going to buy into it, or if the market gaps up, you're going to try and short. All right? A follow strategy would be to trade in the direction of the gap. So if the market gaps up, you're going to buy it, and if the market gaps down, you're going to short it. And that's what we mean by fade and follow. A gap fill is when the price returns to the prior day's closing level. This is also referred to as closing the gap. Okay, so when I say gap fill, that means the price has, after gapping, either up or down, it has moved back to the previous day's close. And the gap size is just the difference between the prior day's close and the current day's opening price, whether that's in dollars or points or however it's measured. So let's first talk about the gap fade. So 10 years tried and true, because that's how long Scott has been trading the gap fade strategy. It's been his bread and butter for the last 10 years, and the Master the Gap website was built upon the gap fade trade. It became InvestiQuant because he started expanding beyond just gap fading. And we're going to look at some of the newest stuff for InvestiQuant in a little bit, which is the following. But let's start with the fade, because that's been the bread and butter for Scott Andrews for a long time, and it's something I've done for the last few years as well. So if you're going to fade the opening gap, that basically means that you are going to short an up gap or buy a down gap, as we said, and that is done at the open or within seconds of the open. And you're going to put a target price at that gap fill area, or the prior day's close. It says 4 p.m. That would be if you're looking at stocks or ETFs. 4:15 p.m. if you're looking at index futures, assuming they're equity indices. Bond futures would probably be 3 p.m. Eastern. If the target is never reached and you're never stopped out of your trade, then the trade would be closed when the regular session is over. So it's not held overnight. So here's an example of a gap trade, and this one worked out great. They don't all work out great, but this is an example. So in this case, there was a large gap down to open the day that would have been bought at or near the open, and then price moved in the direction of the gap fill, and it hit the prior day's close within 45 minutes or so, it appears here. All right, and this would have been the exit price. So buying here, selling at the prior day's close would have made for a nice quick win. And that's basically the trade that you're going for when you're fading the gap. Now, why would this work? Why would gap fades work? Well, there are events that cause the futures market to gap open overnight. Economic events, geopolitical events, even earnings events, right? So there's a lot of news that can occur during the evening or early morning that would cause the futures market to move. 90% of all gaps are what we define as large enough to trade. Okay, that means they're beyond a few ticks. 65 to 70% of all opening gaps in the equity markets tend to fill the same day, and this is something that I'll show some more statistics on shortly. But the important point here is there is a tendency for the gap to fill, and there's a pretty strong tendency, and that's why we're looking to take advantage of this type of trade. The gap fades take advantage of emotional news-driven events. So I mentioned economic, geopolitical, earnings-driven type things will have the market gap, and really that's a reaction to that news. Most reactions to news in the short term are overreactions. And institutions play on this, and they know this. And it's been for years and years where the open has been where the retail trader has often gotten fleeced. Good news comes out about a company or good economic news, and the market will pop higher and then immediately start to retreat. And this is what we're taking advantage of with the gap fade trades. As it says in the trading tip down here, opening gap fades take advantage of the mean reverting bias of mostly large, highly liquid markets like indices and large cap stocks. All right, let's look at some gap fading statistics so you understand how large this edge is and why we've spent so much time looking to take advantage of it over the years. It'll also set you up for understanding why the newest research actually works as well. So this is opening gap fades with win rates year by year in this table. So this is looking from 2006 to 2015, and the average year, you can see that we have filled the gaps, the tradable gaps, so those are ones that are greater than like a tick or two, 68% of the time on average. And really, it hasn't varied a whole lot. The worst year for gap filling was 2013, where only 64.2% filled. The best year was 2006, where 72.5% filled. That's not a big spread. So most years you're looking at close to 7 out of 10 opening gaps filling the same day. This is where we have the inherent market bias that we're looking to take advantage of with gap fade trading. Now, we don't play all gaps, and if I showed you statistics of what would happen if you tried to fade all gaps, you would see that it would basically be break even over time. There is not an edge if you're going to try and go the opposite direction of every gap, assuming you use a reasonable stop size. Here we're measuring the gap by the size of the 5-day ATR. ATR stands for average true range. So range that the stock trades in, or the futures market trades in during the day. If it trades in if it's a S&P 500 futures and it trades in a 10-point range one day and a 15-point range the next and a 20-point range the next, the average of those 3 days would be 15 points. We're looking to average the last 5 days when we're measuring the size of a gap. So as long as the gap is less than 40% of the 5-day ATR, you can see that it's been a pretty good trade, both with a win rate and profit factor has been best between 20 and 40%. Now, profit factor is something that system traders are most likely familiar with, but if you're not a system trader, you may not be familiar with that term. Profit factor is the gross gains a system makes divided by the gross losses. It's a measurement that is used by system traders to compare systems to each other. So for instance, if there are two systems and over the same amount of time, say a year, they both made $10,000, the profit factor metric helps you determine which one might be better. So if system A had $20,000 in gross gains and $10,000 in gross losses, to make that $10,000, it would have a profit factor of 2, 20,000 divided by 10,000. If system B had $100,000 in gross gains and 90,000 in gross losses, that would be a profit factor of 1.11, the 100,000 divided by 90,000. Most people would not view that as favorable. Okay, you'd prefer to trade a system where the gains are much greater than the losses. So that's why profit factor is important. A profit factor of 1.23 there means that gains have outsized losses by about 23%. Okay. Another important, or what can be important factor in gap fading is seasonality. And a real simple way to look at seasonality is simply looking at day of the week. So the stats here look at, based on what day of the week it is, what are the chances the market is going to successfully fill its gap. Well, Tuesdays, Wednesdays, and Thursdays have been the best for filling gaps down. Remember, a long win, a long trade happens when the market gaps down. And those have been over 70% of the time, while Mondays and Fridays have been a little less successful. For gaps up, where you're looking to short the market, Mondays and Tuesdays have not done as well, but Wednesday, Thursday, and especially Friday have done better. So day of the week can matter when looking at gap fills. If you want to look on just a total percent basis, Fridays have been the best day and Mondays have been the worst for filling gaps. It's also important to consider market conditions, and this is just an example of a market condition that makes a difference when considering whether a gap is likely to fill or not. So here we're looking at all large up gaps. large being defined as greater than 40% of the 5-day ATR. We saw that less than 40% of the 5-day ATR ones are more likely to fill, but when we're looking at these large ones that could be large opportunities, we want to see what is more likely to fill based on market conditions. So if it happens following a 10-day high, that means you get a big gap up after the market has already posted a 10-day high the day before, or closed at a 10-day high. What are the chances it's going to reverse and fill the gap? And this uses a 30% ATR stop as well, with a target of gap fill. In this case, you've got a 55% chance of seeing that trade successful, and the profit factor has been 1.3, meaning gross gains have been 30% larger than gross losses. So is that a good trade? Yeah, that is. I would take that trade quite often. If that was the only information I had on it, I'd take it every time. Following a 10-day low, though, so you're off a 10-day low, you're at a 10-day low, closed the day before, the market gaps up big. What are the chances it's going to move back down and fill that gap? Well, the win rate drops substantially. Now it's only a 40.5% chance of that gap filling. And the profit factor shows that anything below 1 is negative, and this shows that gross losses have outsized gross gains. So this is just one example of how market conditions can impact the potential success or failure of a gap fading trade. And that's something to really keep in mind. It's not just, oh, what happens after a 10-day high, or a 10-day low, but really for optimal results, gap selection process. So which gaps are most favorable to trade, should consider historical analysis of what we call similar market conditions. And let's get into that a little bit more. When you're talking about similar market conditions, you can look at the market a number of different ways, and you can use lots of different metrics to determine what you consider to be current market conditions. We use a number of systems at InvestiQuant. They look at things like the gap size, the current trend of the market, where it sits within that trend, the momentum, how fast it's moving, volatility, seasonality, certain patterns, overbought, oversold levels. So there's a lot of different measurements, and we use all of them independently to measure potential success or failure of a gap trade, and then we'll combine that data to produce odds. And this is called ensemble forecasting. Ensemble forecasting isn't only used by InvestiQuant to measure stock market odds, it's also used by weather agencies to determine hurricane tracks and possible storms, things like that. So ensemble forecasting is a great way to look at market odds. And basically when you have the trend, the volatility, the seasonality all pointing in the same direction, that means there's a pretty good chance that you've got a strong edge in that direction. All right. Now that you understand what gaps are and how we've traded them for a long time, let's talk about following the gap. Following the gap is our newest research, and it's a powerful potential trade for us. And there's a lot of reasons we like it, but let's first show you what I mean by following the gap. That just means trading the same direction of the open. So if the gap's up, we're going to buy. If the gap's down, we're going to short. In this case, it was a gap up, and we would go long the gap up. So you'd get long at 9:30, and generally we'll hold for a target that is a certain percent of the 5-day average to range. So just like we use a stop that is an average, or is a percent of the 5-day average to range, you can also use a target like that. So we can look for a 20, 30, 40% target, or you can look to hold it till the end of the day. There are some strategies we employ that basically look to enter at the open and hold all day, looking for trend days. The stop can be placed using a 5-day ATR as well. 30 and 60 are the most common stops we use. and then the trade to be closed at the end of the day if neither the target nor the stop is hit during the regular session. So you may be saying to yourself, well, wait a minute. Gaps have filled close to 70% of the time. I already showed that. Why on earth would you trade against 70% odds? Good question. And that's because many opening gaps still have a high probability of succeeding even if they fill. So here's an example where you had a gap down, it filled, and then it moved in that direction. And that can be a winning trade. So that's one example of how you can win. If we went in the opposite direction, sometimes it'll trend in the direction reaching our target price before eventually reversing and filling. And that too can be a winner. So even if it fills, you can still have a winning trade with a follow trade. And then of course, the easiest wins are the one where it gaps in your direction and then continues going in that direction after and never filling. And that happens about 30% of the time. So if we can use metrics to determine when that 30% is more likely to happen, or A or B are more likely to happen, you can get some strong edges to play. Let's take a look at the general market since 2000. This is using ES, which is the S&P 500 future. What we're looking at here is trading the gap every day using a 30% target with an end of day stop. So we're not stopping out, but we're looking to exit the trade if it moves 30% of the 5-day ATR in the direction of the gap. So it's taking every trade, no stop, looking for a defined volatility target. As you can see, from 2000 to 2009, this would have cost you money. But from 2009 till present day, it's actually done very well. So the market fundamentally changed when the bear market of 2008-2009 bottomed out. And that's an interesting thing to note, that the gap follow has become even more robust since that time. Well, will it stay that way? Maybe, maybe not. It doesn't really matter. We can look to fade gaps and we can look to follow gaps and we can filter by market condition type metrics that'll help us. But it is nice to know that there has become an inherent bias over the last 7 years or so. If we zoom in on that 2009 period, what we see here is if we look to fade the gap with a gap fill target and end of day stop versus following the gap with a 30% target and end of day stop, how has the market performed? Well, you've lost a little bit of money doing the fade, even though 64% of the time it's been profitable. The average loss has been substantially larger than the average win, and that has cost money over time. With following the gap, it actually would have made a little bit of money. Now, these are unfiltered results. Remember, the filtering is a big key to making money in these trades. So you're right about the same percent of time, 64.5. The profit factor is a little over 1 now. So you've seen 9% more in gains than you have in losses. And your average winning trade is a bit bigger. So following the gap has actually shown better profitability, win rate, and average win size over the last 7 years or so. Not hugely a better edge than fading the gap, but enough that you say, well, if fading the gap can be good over that time period when it hasn't necessarily had a huge inherent edge, that following the gap must be even better. It must be worth paying attention to, and it is. And that's why we're so excited to share all this with you. So let's look at day of the week for following the gap rather than just fading the gap. Here we see a few things. Number one, Tuesdays have been especially good for following the gap. Maybe it's turnaround Tuesday type scenario where the market is closed low and gapped up, and then it continues in that direction. But for longs, it's been especially good, showing the highest win rate and the highest profit factor. Other days that have done well include Monday, and from a profit factor standpoint, Wednesday and Thursday actually have been pretty good as well. Friday's been the worst day if you're looking to go long. If you're looking to go short, Friday has again been tough, but Wednesday has been even worse. And the best days for going long when looking at profit factor have been Monday and Thursday, but from a winning percentage standpoint, Tuesday's done the best. Okay, so day of week has mattered a bit. Tuesdays have been great. Fridays have been poor for the most part. Remember that little bit of research we showed a while ago showing how the market has acted after large up gaps? Well, let's look at that again. So following all large up gaps since 2001, following a 10-day high and a 10-day low. Well, we already know you've got a fade edge following a 10-day high. So following makes sense. You don't have an edge, and that's what we're seeing here. Following a 10-day high, trying to follow the gap using a 30% ATR target, you would have only had a 50% win rate, and holding till end of day, your profit factor would have been 0.67. In other words, you're losing money. Following a 10-day low, though, you've got a 63% win rate and a profit factor of 1.69. Those are good numbers. All right, so you want to be looking to fade large up gaps following 10-day highs, and you want to be looking to follow them after 10-day lows. What about large down gaps? We see here the opposite. After a 10-day high, if you have a large gap down, you now have a good chance that the market is going to continue moving lower. But if you're already at a 10-day low and you get a big gap down, you do not have a good chance that it's going to continue moving lower. Profit factor of 0.5 means that gross losses have been twice that of gross gains, just as the profit factor of 2.0 following a 10-day high means that gross gains have been twice gross losses. Here, what it's basically taking advantage of is a bull trap, right? When the market's at a 10-day high, people have bought and pushed it up the day before, and now those people are trapped on the gap down. In the previous slide, we saw following a 10-day low had a strong edge for follow. And that was a bear market rally that you were looking to take advantage of there. Let's consider stops and targets. Bigger stops, if you're using large stops, that'll generally increase your win rate. The tighter the stop, the lower the win rate. This makes sense because the tighter the stop, the higher the percentage chance that it will get hit. 30% of the 5-day ATR is something that I've mentioned we use a fair amount for win rates. We'll also sometimes use 60% or other percentages. But 30 is the most common among the strategies we employ at InvestiQuant. Targets, we've found, if you use a target that is less than 50% of the 5-day ATR, you can generally have a pretty high win rate. Extended targets can offer larger profit opportunity where you're looking to hold it all day. Of course, extended targets also will lower your win rate because you're not getting out when the getting's good. You're looking for those trend days, and when they don't occur, the market might reverse and stop you out. Really, there's no right or wrong choice. It's a matter of your desired win rate, whether you want to go for home run trades or not. So there's give and take between stops and targets, and it becomes a personal decision. Now, why would anyone who already has a good fading plan want to add follow the gap to that? And this is what got us real excited. First of all, it gives you more trade opportunities. Rarely with what we look at will you see a fade and a follow on the same security occur in the same day. If there's an edge for one direction, there's generally not for the other. Some follow strategies have home run trade potential. We talked about this. Looking for an end of day target, you can knock it out of the park with a trade once in a while, and that's a nice thing to be able to do. It adds more diversification rather than just fading gaps, and more diversification is most of the time a good thing. You got better overall return potential and smoother equity curves, is what we found. Lastly, without conflict, and this is an important point, we don't need additional capital in the account. So what I mean by without conflict is that you're not having a fade and a follow trigger at the same time. And since you're only trading one direction or the other, it really is just a gap strategy now. All right, well, now that you know about fading the gap and following the gap, our newest stuff, let me just quickly show you some of the tools available at InvestiQuant that will help you make decisions. This is our guide, and this is an example of a gap follow guide. And what we see here is that it's using a 30% ATR stop and a 30% ATR target and producing odds based on that stop and target combination. So in this case, this was on October 10th, it said there's a 66% chance or 65.5% chance that it's going to reach the target before the stop. And the historical profit factor would have been close to 2. Even more impressive is that all 5 of the gap follow systems we examined showed a good edge. So InvestiQuant subscribers could use this information to determine that there's a good chance that the market is going to continue higher if there's a large gap up, and they could look to play that gap up that day. We do have strategies that use this information inherently that will trigger automatically for traders. So this is an example of an alert page. Captain Juno is just a name for a strategy that looks to get long on a gap up or short on a gap down based on whatever the odds are showing for that day. And the alert shows you the potential areas, and the actual entry occurred at 9:30, and 10 minutes later it actually did work out. This is the trade for that day, I believe. Yeah, you can see there, October 10th. I mentioned that the fade and follow are great complements to each other. Let's look at a couple of strategies here that are available at InvestiQuant. Brother Otis is a gap fade strategy that we've had for quite a while, and Captain Juno is a follow the gap strategy, which is new to us. And these are showing back-tested performance of these strategies. They're hypothetical results, and they assume $10,000 is the initial investment, and you're trading one contract each time the trade triggers. So for Brother Otis and Captain Juno, these statistics look back to July of 2008. As you can see, we have gross profits of about $60,000 for each of the strategies. Maximum drawdown is $2,500, almost $2,600 for Brother Otis. That's the larger of the two. And there's several statistics here that look pretty good individually. If we combine the two, what you can see is hypothetical results. You now make twice as much money. You don't need twice as much capital to do it because you are doing one or the other. So you've got more trades, you've got substantially more profits. There were a few trades that overlapped, and if you took them, they would have resulted in some additional profits. If you didn't take them, because there was overlap that day, that is also an okay decision to make. Drawdown decreased. So instead of being $2,500, it's now down to $2,300. And IQ ROMAD increased. ROMAD is return on investment over the max drawdown. And we measure it based off of max drawdown from the initial investment, not from the equity high, which is a much more conservative measure. Here's an example of a portfolio of 4 strategies. So this gives us the Captain Juno, as well as one other gap follow, which is called Camera Ready, and then quick hit and double check are 2 gap fade strategies. So this assumes starting capital of $20,000 because you've got two of each here, and you can see the profit curve. This is done on the InvestiQuant site, and if you want to go and see how some of these strategies would combine the fades and the follows together, you can do that on your own. Just go to InvestiQuant.com/strategies, and you can play with what we call our portfolio tracker on your own. So I invite you to do that. I hope you do go and do it. Additionally, like I mentioned earlier, go to InvestiQuant.com/tradersworld, and you'll be able to download your complimentary ebook, which Scott wrote several years ago, called Understanding Gaps. It'll have the gap information in there that we talked about for fading the gaps. It'll also have a lot more for fading the gaps. It's a great resource. It's a great way to learn about understanding gap research. And we're very excited to now be able to trade in both directions with some home run type potential trades with the new follow strategies. So go ahead and learn about that. Visit us at InvestiQuant.com. You can follow us on Twitter or Facebook, or you can RSS our blog. And feel free to email support@InvestiQuant.com if you have any questions as well. Thank you so much for listening. I'm very excited to have been able to present here at Traders World, and I hope you got a lot from the presentation. Thank you. Good luck trading. Bye-bye.